Okay, well, again, everybody, welcome to the Mid-Michigan Roundtable. It's a monthly discussion group between four very good friends, Mark Robertson from Rochester Hills, Hugh O'Brien from the Pasadena area, Cy
That'll
Lynch
be
from,
McManus.
what did I say, Hugh who?
You got an Irish name, but it's
I'm on,
McManus.
I'm on autopilot, huh? Hugh McManus, I'm sorry, folks. Cy Lynch from the Atlanta area, and myself, I'm from mid-Michigan, live just north of Flint. We'll be discussing four stocks that are interesting to us and talking about what our goals are, and I'm going to turn the program over now to Mark Robertson. Take it away, Mark.
All right, thanks, Ken. First of all, let's give a shout out and say welcome to all the returning people, and an extra big shout out to and a welcome hug to those that may be joining us for the first time. We do this for the fun and for the spirit of sharing some potentially rewarding investment ideas with a wonderful community of investors. I'd also like to make it clear that none of the four of us are replacement referees, nor do we play one on TV. So just to make sure that the air is clear when it comes to that sort of thing, those replacement referees are having a tough time. So let's go ahead and get started.
I saw a joke today. Did you see that Foot Locker put out a press release making sure that everybody understood that none of its employees had left the store last Sunday?
I think that's a great idea on their part. Something you definitely want to be clear about, especially since they're running around in those uniforms all the time. Let's go ahead and get the legalese out of the way first. Again, this is a session where we will be talking about real companies in real time, rendering some opinions, walking through demonstration of some judgment techniques and some analysis. But please, please, please keep in mind that no investment recommendation is ever intended by anything that we do, and that everything we do is for demonstration purposes and for education and illustration only. So we may be talking about companies that we own. We will usually disclose when we actually personally have a stake in a company, but we may forget to do so. So again, no investment recommendation is intended whatsoever. Here's our agenda, just to give everybody kind of a rough run of what we're going to go through. We'll spend a few minutes talking about what we do here, along with section 2 there, talk a little bit about the history and results. And then what we thought we would do tonight for a bit of an educational topic to kick things off is discuss some of our favorite screens. And I've put together a series of screens. Some of you may have noticed the series in the Manifest Investing forum tonight already. We're going to actually step through those. And then we'll go into our four stock selections. As we said, Hugh McManus will be unable to join us tonight due to business travel conditions. He's been just on a whirlwind, and when I talked to him early today, he literally sounded exhausted, so he's not going to be able to make it. And then Cy Lynch is not here at the beginning, but he will be joining us at some point, so we can listen for that accent of his wonderful accent. And then we will actually open the floor up for an audience vote. We'll poll with all four selections tonight, and then if there's any time left over, leave time for questions and answers. All right, just a reminder what we're here and what we're all about. We've been doing this now for a little over 2 years. The intent is to identify valid opportunities with potential for long-term strong performance. We really want the collective performance of all the stocks that we choose to outperform the Wilshire 5000 by 5% over the long term. That's our objective. That's no different than what we know in the traditional objectives of the modern investment club movement. And our accuracy goal, in other words, we would like to see 60 to 70% of our selections actually outperform the market after we choose them. And again, some of them require some patience and some gritting of the teeth and discipline, but more on that as we go. Here's a look at our results so far. We basically are graphing where we're at. We are not anywhere near. By the way, this dotted line should actually be up at 5. I'm not sure why the scale changed here, but that the objective is to get up to a 5% return. And you can see that there is one little bubble. We'll talk about that in a minute. We expect to get there over the long term. If we keep our heads down and keep picking stocks. We've been unfortunate with a few picks. A few of mine have been attempts at catching falling knives, and I'll do a mea culpa for a couple of those. And but I also will urge that in some cases it might be just a matter of waiting a while longer. Who knows? Our outperformance accuracy isn't quite where we want it to be yet, but not too bad. It's up approaching 50%. And we're basically sitting at about a -2% versus the market here. And the little bubbles that you see here are the pieces that make up that -2%. This one up here is the important one. That's the audience selections. The audience selections that have been made 4 or 5 times over the time that we've been doing this actually have a group annualized relative return of plus 5.1%. And then Ken's up here with one of these, and our guest damsels are up here. And then we're not going to talk about who these people are down here, but trust me, I'm one of them. Here's a look at recent results. We keep track of every selection that is made, whether it's by one of our individuals, whether they be the knights, guest damsels, or the audience. And you can see that we basically track every single selection and compare it relative to the stock market over time. The market returns are displayed there, so that's what we're benchmarking against with each individual selection. So you can see from the very top there, Southwest Airlines, love, that was one of our special situations picks, probably either selected by me or Hugh back on April 30th of this year. And you can see that love, in this case, Southwest Airlines, is up 7.9%. And again, that's just the absolute return during a period when the stock market is up 2.5%. So we call that a win so far. Again, it's a work in progress, but it's a win because this number over here is positive. So what we want to see in that far right-hand column is green ink. And thank goodness we see a fair amount of green ink. You can see that our best performer so far, at least in this small sample of what we've done in recent months, is IPC, the hospitalists, with this plus 23% relative return. The one that is...
Yeah, don't miss PRAA up there near the top too, Mark, with almost a 50%.
I did not mean to miss that. Yeah, and I think I know who picked that one because he just pointed it out.
Well, he picked both of those, but that's okay.
Because are you taking those kind of personal, huh? And then on the other end of the performance spectrum, I did double down on Research in Motion back on April 30th. I never dreamt it could go to $7 a share. Apparently now $7 is what most people think it's worth. But you can see that this one has, let's just say it's compromised my performance of late. And we hope to see Research in Motion recover a little bit. Either that or someday we'll throw in the towel. So again, here's the collective results. The accuracy, 44.8%. Again, measured by every selection we've made since July 2010. And here are those performance numbers, so you can see where the negative 2% return actually comes from. Again, it's annualized. We're shooting for plus 5% in that final column. Any other comments there from the ringleader there? Mr. Kavula?
No, things look good right now. Yeah, let's
All right, we'll keep cranking away.
Forge on here, okay.
All right, just to give a little background, we do operating a tracking portfolio. These are the selections that have been made over the course of that 2.25 years. And you can see that Walgreen has been the most frequently chosen up at the top by virtue of its 7% of total assets rating. But again, just to give a feel for some of the companies that we have chosen, a lot of household names on that list, maybe a couple that are a little bit less familiar. In the case of, for instance, a Hawkins might be a little bit less familiar to some people. But in general, you're going to find that these are stocks that are fairly well known by most of the people in the community. And again, our mission, and it's the mission of everybody here, is to search out higher quality stocks and try to buy them when they go on sale.
Mark, we're getting a question from Tracy. She wants to know on the previous slide why Echo was in the chart twice. I think if you look closely at that chart, you'll also see Fossil on there 3 times. Occasionally what happens, Tracy, is that 2 of the knights will choose the same stock. In June, Mark and I both chose Fossil, so that accounts for 2 of the choices on the chart. And then recently we've been giving the audience a chance to tell us which of the 4 stocks they think is the best choice, or they have the option of not choosing any of them. And in the June roundtable, the audience also thought Fossil was the best choice. In July, the audience thought Echo was the best choice. And in August, on 8/27, the audience thought eGov. That's NCI Incorporated, thought it was the best choice. So you get the double listings based on how many times they were picked by the Knights, and then recently we've been adding an audience choice as well.
Okay. And the audience, as we said, accounts for that top bubble up here. So again, the wisdom of crowds, the wisdom of communities often seems to be the case. All right, so again, those are the representative stocks in the portfolio. Ken, why don't you take a walk through the roundtable from the perspective of our dashboard diagnostics?
Sure. Every time that I look at a portfolio, I want to reduce it to something that's clear enough for me and that has the same consistency that I can decide what steps to take with my portfolio because I'm using the same procedure. The procedure that I use is from Manifest Investing, and I like to check out the portfolio averages no matter if the portfolio holds 10 stocks or holds 100 stocks. The first thing I'm looking for is where is the market today, and at the end of the day today, the market as measured by the database that we're using, that's about 2,500 stocks. The market is about 8.5%. That means that if we did an SSG on the middle stock in the entire database, the average stock, whatever that might be, it would be returning going forward about 8.5% par. That's an annualized number, and we define 5 points above that 8.5 then as the sweet spot. We think that if Nicholson were alive today with modern tools, instead of setting a static goal of 15%, which is 5% above the long-term stock market average, we think he'd probably be counseling us to try to stay 5 points above the market wherever the market is moving. You know, ask yourself the question, if the market's returning 20%, are you happy with a 15% return? I think that's an obvious answer. No, you shouldn't be. And so we're looking to stay about 5 points above the market. That means that tonight I'd like to have my portfolio at about 13.5% potential. I'm not going to be greedy, so I'll cap it at 10 points above the market, although there's nothing to stop me from looking at a stock that might have a 19 or 20 or 21. But once it gets above 18.5, I'm going to think very carefully about the fact that the returns might be too good to be true. I might have become a little bit overzealous on completing my analysis of the company. So that par number, I'd like to keep it in the sweet spot, and for our portfolio it is at 14.6. I'd like to keep the quality at 65 or better because the top quintile stocks, the highest quality stocks, according to Benjamin Graham, according to George Nicholson, these are the stocks where I'm going to make money with less risk than I might take by looking at some of the turnarounds or some of the issues that are having immediate problems right now. We also know that if we have growth, this is sales growth, if we have growth in our portfolio somewhere in the 10 to 12% range, that probably we're going to be all right to hit that goal of hitting 5% above the market. The rest of the growth in my portfolio is going to come from PE expansion. So I'm looking for growth at the 10 to 12% range. That's a good, solid, medium-sized growth, medium-sized company. And to achieve that growth, I'm going to want some large companies and a lot of medium-sized companies and a fair sprinkling of smaller companies to get that growth in the 10 to 12% range. You know, I'm looking at all of the graphics, I'm looking at the numbers, and things look pretty good in this particular portfolio. I don't pay too much attention to PE ratio, although I think if that number went up into the 20s, I'd worry about it. And any yield that comes, for me at least, in the portfolios that I manage, I love to get and I love to spend, but I don't focus on yield when I'm doing my growth investing. I do like to see financial strength and earning stability numbers at least above 70, and I think they're great when they're above 80. So I think altogether, even though we haven't aimed at these numbers, I think we've pulled together a pretty decent portfolio. Way too many stocks, of course, for any one person to follow, but a good representative of the kinds of companies, with some notable exceptions, that better investing members probably would want to take some serious time and take a look at them. Mark, Don is asking if you can build a template that a club could use, like the dashboard diagnostics roundtable tracking template. And I think it's already there, isn't it, when we talk about the portfolio averages?
Yeah, I think it is already there in terms of shooting for those target ranges and using a dashboard type approach to any particular portfolio, any particular club. We have scads of clubs that use this approach.
So the moment you put your holdings into a dashboard, you'll have these averages, and once you have the averages, it really helps with portfolio management. Marianne and Phil Wrench from Northeast Ohio want to know what a 1 in the accuracy rating column means. Marianne and Phil, the 1 just means that it's beating the market at the current time. It would get a 0 if it wasn't, and that's how we can tally the percentage of accuracy that we're keeping on all of the stocks that we're following. And then Ann Mark is asking, how would we get the particular graph on manifest investing, the graph that's to the right of this slide?
You know, that's interesting because we don't actually provide that graph on the dashboards yet, but maybe we should. So it's something for us to give some thought to. We do have, we didn't actually include them tonight, but we do have pie charts representing sector diversification and size diversification or growth diversification. If I jump out of the presentation just for a second, we'll go over to Manifest and look at the dashboard. And you can see here at the bottom of the dashboard display, kind of finishing off what Ken had to say. The sector diversification is fine. It's pretty well distributed amongst the various sectors. And again, that's something that happens naturally. As Ken and Cy and Hugh and myself try to bring ideas to this table, we just naturally shop amongst all those sectors. So we're going to find a little bit of concentration in technology because of some of the opportunities that have been harvestable, if that's a word, here in recent months and years. And then healthcare also has had some decent opportunities. So diversified pretty well by sector. And then as Ken was pointing out, with that overall average sales growth, we do have a pretty nice distribution of faster growing companies, slower growing companies, our stalwarts, and the medium-sized companies. Nice looking pie chart. And again, the only 2 numbers you need to remember, in our opinion, are any company growing above 12% can basically be considered to be a smaller company. Any company growing at a rate less than 7% can basically be considered to be a larger company or a stalwart. And again, that's a pretty healthy distribution that we're looking at there.
Mark, you're getting a lot of people that say that would be a welcome addition to the dashboards, to have a graph similar to the right-hand side of this screen.
I'm amazed that I haven't actually had that before. So yeah, that's a nice suggestion, and we'll certainly take it under advisement and see if we can't make it happen.
Rob Stevens wants to know, do all dashboards have these pie charts associated with them? And the answer is yes, absolutely. You can choose to turn the charts on or turn the charts off, but if you make a dashboard and if you populate it with actual shares of stock, then the pie charts will appear.
Yeah, the pie charts are actually down beneath the dashboard. You can see this one's actually quite large or long, and then you can turn the charts on or off with this toggle switch over here to the right.
We're getting a comment from Julie Warner that is probably a good discussion point, Mark.
Okay.
Julie wants to know if we would hold core holdings, give them a little bit more room to have some issues than non-core holdings. And her question basically is, what % of a portfolio should we hold in core holdings versus non-core?
Oh, that's a great question. One that we probably should tackle in an entire session, but I can nutshell it a little bit. especially for experienced investors. If you've been doing this for a while, and George Nicholson, the founder of the National Association, one of the founders anyhow, in his counsel with investment clubs going back over the decades, he basically said that when you've been investing on average, some people get there faster than others, but on average about 5 years, you can actually move into a mode where you can consider something beyond core investing. The vast majority of what we do, you hear Ken talk about it all the time, up, straight, and parallel. You're always going to do that. You're always going to have core holdings, and it's always going to be a significant percentage of your portfolios, both individual and club-based. But what Nicholson basically suggested was, with a little experience, you can take as much as 25% of the total portfolio and begin investing in things that are what we call non-core. They could be special situations. They could be very low-growth companies. A recent example here over the past couple of years might be a company like Ford. I know that Ken in his family club actually purchased shares of Ford, and there's no way you could justify that as a core holding. I'm sorry. We're from Michigan, and in fact, in this house, Ford is a four-letter word because my wife works at Chrysler. But that was an example of a high potential return going back 2.5 years that you couldn't even do a stock selection guide on. And that's what we mean by non-core. And non-core could also include, like I said before, special situations. So again, depending on who you are, what your time horizon is, and a number of personal factors, that number could be as much as 25% within a portfolio. And I give one last thing for people to chew on. We've worked with a club here, a highly successful, phenomenal investment club here in Michigan that has been has basically been around for approximately 40 years. And they were in danger of disbanding and just basically giving up. And the whole thing was over. Half of the club wanted to do some non-core investing, and the other half of the club wanted to do core. We spent some time with them and said, you can do that. You basically divide the portfolio into those two slices, and that club is still going, and in my opinion, they're thriving and really having a good time. So hopefully that gives you some idea of what you might consider there. And we will be talking more about non-core versus core. In fact, I'm putting together a class for the Puget Sound Investment Conference in November that deals with that subject. So we'll probably bring that here too.
Mark, we're up to date. Why don't you continue on the slides that we have? All
right, we're chewing into the time pretty good, but let's go ahead. What I wanted to talk about for just a few minutes is to talk about a little bit of screening. And I want to basically make the point that this comes at you from several different directions. In this case, what you're looking at here is the dashboard for the round table stocks. This is our tracking portfolio for the stocks. And again, it's a source of screening ideas. And very often Ken and Cy, for the most part, will basically pull this up, and they begin hunting, again, in that sweet spot. These that are color-coded in green are basically stocks that are likely to be somewhere near the buy zone in a stock study. And some of these towards the bottom end of this slightly frothy, could call it too good to be true zone. So again, just the portfolio itself for screening or shopping within the portfolio, again, we're going to look at some of the companies that are kind of in this midsection, hovering around at the top of that sweet spot. Here's what it looks like in throwing out some of the ones that are a little bit lower quality. And again, we would be hunting always kind of at this dividing point right here. Let me turn my pen back on because I did turn it off. Refill the ink. And again, we're talking about kind of shopping somewhere in this zone here of decent looking returns, kind of at this break point where it turns into the be careful zone. Nothing wrong with shopping at the bottom. For shopping outside the portfolio, one of my favorite screens is to go to the stock search manifest and search on it. You put in one number, and that number is this 99.44. We call this the ivory soap screen. And one of the reasons I like to do this is to, again, go ahead and shop outside the portfolio. I'm going to come back to this one with my selection of Coach in a few minutes. In fact, I made a mistake on this slide because I thought the roundtable portfolio already had Coach, and to my surprise, we don't. So the ones that we don't have that come up in this particular search are Mindray, Synchronos, Ritchie Brothers, AeroVironment, and Qualcomm. So those could be candidates for, again, new companies to add to the portfolio. Here's another place that I like to turn to look for ideas for shopping. Again, we're talking about screening. We're talking about shopping. This happens to be the Manifest 40 dashboard. Again, it's a public dashboard available on our homepage. And these are the 40 most widely followed stocks by our community. Same thing as shopping within the roundtable portfolio itself. I'm going to be naturally drawn, and the same is true for Cy and Ken and Hugh to some extent, to these that are kind of in that very nice area of the sweet spot. They're kind of in the zone. And you see a number of names here that have been quite popular. I was very close to choosing Infosys Tech for tonight based on some of these screening results. I like Oracle also. And you just see a whole lot of those tech stocks that are bubbling up to the top. Here's another idea for you to consider. Every Monday we put out, or every weekend now, we put out a screen, which we refer to as our panoramic screen, where we do some of the same kind of stuff. We search for companies that have financial strength ratings greater than 70, that happen to also be in the top percentile when it comes to that manifest rank. So we're basically looking at companies that have strong quality, strong return forecast in the form of par, and also decent financial strength. And then we add one more element to it. The ones that you see color-coded here in green are those that have bullish sentiment. So again, the ones that are in green are bullish. The ones that are in red here are, at least temporarily, bearish. And then the ones that are in between, color-coded in yellow, are exactly that. They're in between, kind of toggling between bullish and bearish, kind of deciding which direction they might head. So again, this becomes kind of a tiebreaker. And I'm pleased to see Coach in the bullish, which had just turned from being in the middle zone, showing up there. And again, this is something that I will use if I'm trying to be a little bit more delicate about a price entry point.
Mark, Nancy has a question. Could you give a 30-second answer as to how you develop the Manifest 40 list?
The Manifest 40 is really simple. We basically take a look at the collective of all dashboards at Manifest Investing and simply tally up the dashboards. And we publish that on a quarterly basis. So again, it's a matter of how often, what frequency they appear on dashboards. And in fact, with this most recent quarter ending this September, Apple dislodged Stryker from the #1 slot, and we've had just a blast watching Apple climb up that list. It's a new member of the list that was added about 2 years ago. So it's kind of fun. All right, one of the things you've heard us talk about a lot, and again, it's a form of screening, it's a form of shopping, is to find somebody that you think has a pretty good handle on investing and follow them. We call this going Hebner. He's been on kind of a cold streak for a couple of years, but he has such a phenomenal long-term track record. His relative return over a 15-year period is plus 6%, although for his 1 and 3 and 5-year numbers are not strong. So I don't know what's in the water he's from the Boston area, but he's been on a bit of a cold streak. But here's an example of how you can take somebody and follow them. Another example you might use is one of our favorite small company funds. It's Buffalo Small Cap, BUFSX, Buffalo Small Cap. Might do the same thing as kind of a homework assignment when we're done here. BUFSX. Go to Morningstar, pull up their holdings, and what you're looking for is, again, which stocks are relatively new. And I find this kind of fascinating because Ken Hebner's got a whole bunch of discretionary stocks that he's been pursuing here within the last quarter. All of those new to the portfolios. And then I also find this one kind of interesting because I remember the day almost 10 years, well, not 10 years ago, 5 or 6 years ago, when he walked completely away from the home builders. He basically sold them all on the same day. And now we see one of the ones that we've tracked here in the community for years showing up at the top of his list. It's also kind of interesting to see a couple of the banking names, including this one, up at the top of the list. I'm sure he would give a nod to that one if he were here. So again, that's another technique for shopping and having some fun. Again, just some other concepts to think about. This happens to be the same type of concept, only in this case we're blending a little bit of technical stuff with our fundamental analysis. We refer to this as our fusion. factor, where we basically take a look at companies, and what we're looking for is companies that have strong momentum characteristics. We'll talk more about that as we go tonight. Bullish trend characteristics, along with, again, very strong fundamental characteristics when it comes to return forecast and quality. So you see some names on here that are kind of compelling of late. We've recently talked quite a bit about Teva Pharma around here. Mercado Libre is one that's been fairly popular. Again, names up and down this list. I was drawn as I looked at many of these to Cisco, to give that some thought tonight. BioReference Labs. So again, just an idea of some screens. These are all current information, so again, another log on the fire. Another thing that we like to pay some attention to, because we know that well-formed stock studies generally will align pretty well with the value line low total return forecast. So in this case, we're ranking here on the right-hand side all the low total return forecasts from some of our favorite companies in the value line standard edition. Again, these all have the characteristics of decent return forecasts, very high quality. But one of the things that you're going to find when you're shopping, and this is something that we have to kind of get used to or respect as long-term investors, when you're shopping amongst some of these higher return candidates, think of it as deeper value shopping. Notice the number of these that are out of favor with basically Wall Street based on price activity. Look at the number of bearish trends, or the ones that are kind of stuck in that toggle or neutral zone. So again, if you're shopping amongst these type of stocks, a lot of times you'll latch on to one of them, even though it has a great-looking stock selection guide, well-formed stock study. It could literally be stuck kind of in the mud for a while. So something to keep in mind, especially when you reach for some of these higher returns. Again,
Mark, we're getting a number of questions. Are all of these screens available on the Manifest site?
Several of them are. Others are just available within our database. But no, not all of them are. Anytime you see a dashboard, they are. This one is not. But we do track value line low total return forecast with on every stock at value line, and we publish that every Monday morning. As far as when we publish this week at Manifest Investing, we actually cover each update issue, and we single out the high return, according to the low total return forecast for the companies every week. This week was issue 6, and there's actually only a couple of companies that were of interest. So no, they're not all available, but again, just showing you some of the stuff we look at as we form some of these ideas. Here's one that's not at Manifest at all. It's at stockcharts.com. It's a free site. You can actually go into their predefined scans, and you'd be looking for companies that meet the condition of oversold with improving relative strength. And in this case, only one of them catches my attention at all. It would be Lawson, and it doesn't hold my attention for very long looking at this picture. It's a company clearly challenged. The other two companies, be careful anytime you're dealing with kind of penny stocks, and anytime that these prices get too low, I just disregard them or ignore them. Another couple places that I'll turn to, again, just shopping for ideas on the fly. This is from Morningstar.com. You can actually go into the stock screener and look for companies that have the lowest price to fair value ratio. So again, you can just kind of scan down this list looking for names that may be interesting to you. Could be a name like Apollo, WMS. Notice the car companies here that are deeper value opportunities. Again, you can use this as a nudge, an opportunity to find some shopping candidates that could be relatively deep value. Here's what they look like within the Manifest database, where we actually do throw out some of them that are of lower quality. So we've got these also filtered down to include only the good and excellent companies, none of the special situation or non-core. And you can see from top to bottom there are some fairly interesting names, and basically all fair value is Value Line Morningstar does the same type of stock studies that we do, only they stand on their heads, and they compute not a future return, but a present day fair price. And that's what you're seeing here. In the case of Ultra Petroleum. They think that a fair price today for that company is 47. So literally with it at a price of 21.44 today, we're basically talking about a 54% off sale. That's the way to read that number. That 46% price to fair value means that they think it's undervalued by 54%. And that's the equivalent of a big red sale tag hanging off some of these companies. And again, you're in kind of a minefield. You have to walk through it carefully. But there occasionally will be companies here that capture our attention. For instance, look at the one down at the very bottom. That's definitely a community favorite over the years, which has had a few tough moments, and could be one worth taking a closer look at. So some of the stuff we look at as we go through and do some stock screening, just there for your consideration. In the manifest forum, we walk through all of those selections, and we'd be interested in hearing some of your favorite screening criteria or resources too. Please feel free to contribute to that discussion in the forum. So with that, Ken, do we have any questions that we need to clear at this point, or should we go ahead and launch into your can't miss selection?
Yeah, we're in pretty good shape, Mark. If you could, or I'll just take the screen here if you don't mind. And I'm going to start my presentation. My stock this evening is Cash America. And before I put anything up on the screen for you to look at, I want to make a statement. This is an extremely interesting industry, Cash America. It's a financial stock, but it's in the area of around the periphery of financial stocks. Cash America deals with loans, but not loans in the traditional way that you might think of them from a bank. The caveat that I want to put forward is that the government has been sniffing around these types of companies for a while. They've laid off for the time being. I think maybe the election has something to do with that. But my caveat is, if the government becomes extremely interested in this type of stock in the far future or the near future, I would advise you to be very seriously aware of that fact. And if the government becomes seriously aware to the point that they're going to pass regulatory laws for this type of industry, I would suggest that you might be staring a freight train right in the nose. It might be barreling down the track aimed right at your investment, and the thing that I would do is just gracefully step aside. I wouldn't try to stop that freight train by putting up my arm. That being said, I really like this company, Cash America, ticker symbol CSH. I've done a fair amount of research on it in the last couple of months, and I'm starting by showing you their investor relations page because it's very, very robust. Down here there's a tab called Investor Presentations. That's the tab I happen to be on. And I would urge any of you that have a good, serious interest in this company not only to look at the PDF that exists right here from June 30th, but also to click on the presentation that they just made a couple of weeks ago in New York City to the C.L. Kling 10th Annual Best Ideas Conference. These are both full of information. I just caution you to remind yourself who's actually writing the presentation. With that in mind, I'm going to show you a few slides from that Cash America presentation. Cash America is involved in alternative financial services, and it operates in the United States, Great Britain, Canada, Australia, and Mexico. So it doesn't have a huge footprint in the entire world, but it does operate in places that we're familiar with. Cash America operates in two basic divisions, retail services, and the revenues from retail services are the red part of the bars on this bar graph, and then they also operate in the ether, in e-commerce, and the e-commerce portion of their revenues are growing much more quickly than the retail services portion, and that's represented on this bar graph by the blue or aqua part of the bar. If you're looking at the types of industry or the types of places where Cash America operates. They have a string of pawn shops, and the total pawn shop loans are in the dark blue on the bar graph. They also have other storefronts that do things like payday loans, but they're much more sophisticated than just simple payday loans. They actually have a fair number of services available through these storefronts, and that's in the light blue portion of the bar graph. And then again, they have online services. That's the yellow portion. The orange portion, the other part of their business, they've divested themselves of. So as of 2010, we're basically looking at pawn shops, storefronts, and their e-commerce sites, their online loans that they make to individuals. If you're looking on a cash basis, if you're looking exactly how this breaks down in percentages, the retail services is in the blue parts of the pie chart. The e-commerce is in the coral and orange parts of the pie chart. And you'll notice that about 2/3 of their total business is domestic retail services. About 3% is coming from foreign retail services. And then that means about 1/3 is e-commerce, with it being split fairly evenly between domestic and foreign e-commerce. I think it's interesting to look at the kind of person that takes out a pawn loan versus the kind of person that typically takes out a payday loan. You can read this and draw your own conclusions from it. It strikes me, however, that many of these people are high school educated. 82% of pawn loans and 91% of payday loans go to people that hold a diploma or a GED. And these loans are really very, very small. They fill a need for a certain class of people that don't have access to traditional banking. You'll notice that there are fees attached to these loans, $20. On a $100 loan, 11 to 25% on a loan of a $400.
Ouch.
And you notice that they're extremely short term. The e-commerce platforms, if you're looking for some of the names of these platforms, do not operate in Mexico, but they operate 4 e-commerce platforms, and the names are on the screen here just for you to take a look at. If you want to play around with them a little bit, you might want to just go to one and see how it operates. I'm looking at the alternatives, and this was a real eye-opener. Notice that this source is not the company. This is sourced to the Community Financial Services Association of America. I went to their website. They appear to be an industry group that collects data on financial services companies. And look at the fees attached to a typical $100, call it a purchase, I guess, if you will. If you're doing a payday advance, you'll pay $15 to $20 in fees. If you're trying to protect against overdraft, typically you'll pay $29 in fees. A credit card will bill you $37 if you're late on a $100 fee. And if you bounce the check and the merchant gives you non-sufficient funds penalties on top of that, you could be liable for as much as a $58 fee. The people that are taking these kind of loans operate in areas that many of us just do not operate in because of the types of institutions that we take our loans from. And by looking at this particular comparison, it appears that the payday loan's not quite as bad a deal as we first believe when we look at just the payday loan by itself. If we're looking at the brick and mortar parts of the business, the brick and mortar is in the United States and in Mexico, and here's the brand names. So you might have passed a Cash America brick and mortar without even knowing about it. They call themselves Super Pawn in the United States and Prenda in Mexico. And again, their core business for this company is storefront lending. That's 2/3 of the business comes from this storefront lending, and that lending is broken down into pawn shops and then also into storefronts that have many other services besides typical pawn services. Again, an interesting fact, 70% of the pawn loan portfolio is secured by jewelry. So it's a pretty stable portfolio as far as what backs it up. Cash America is located in by the map. You can see the states where it is located. It is in the state that I live in Michigan, and it's focused in southern Mexico, around Mexico City. The branches are growing fairly quickly in the United States, and there's plans to grow the business in Mexico. They've been doing some significant acquisitions in Mexico. It's the industry leader in pawn stays services, and these types of services are not regulated nationally. They're regulated on a state-by-state basis. And notice that loans only average about 45 days, again collateralized by jewelry, and about 7 of the 10 loans are repaid, which means that about 3 of the 10 loans the merchandise is forfeited, and when the merchandise goes forfeit, notice the profit margins that the company makes, the pawn shop actually makes. I told you that they're looking to build out in Mexico. The estimates are that there are about 60 million underbanked customers in the U.S. Underbanked is the polite term for people that normal traditional banks won't even look at to give any kind of loans to. In Mexico, the estimation is that there are 80 million underbanked customers. So you can see there's a large amount of room for increasing these storefronts and these pawn shops in Mexico, and that's where the business is going to be focused going forward. This is just a slide that pulls everything together, talks a little bit about what they'd like to do in the future. And those slides will be available on the Manifest Investing website if you want to take a look at them. I'm going to move real quickly to the SSG, and what draws me to the SSG to start with are these lines. They're up, they're straight, they're parallel, and they've been going on for a reasonably long amount of time. I've decided that a 12% growth rate is realistic. And by using the preferred procedure, I have a growth rate in earnings of somewhere just shy of 15%. I like the fact that the margins have been on a very slow but steady upswing. I also like the fact that the return on equity has been amazingly consistent for the last 4 years, and that it's hovered around that 15–16% mark, which I consider a mark of a good company to be able to return on equity 15% year in, year out. Remember, this is a financial company, so debt numbers will be higher than you might be used to because of the type of business they do. I've decided that PE values going forward of 13 and 6.5 might be appropriate, and that gives me a par value of about 18.5. If I look at Manifest Investing, which I've lost off of my sheet here, so let's bring it back real quick. If I look at Manifest Investing, it should never happen. You're right, Mark. Forgive my internet here. It's going a little bit slowly this evening. Here we go. And if I go to stocks and put in the symbol CSH, you'll notice that Manifest has a 19.3% par, which is in the same general ballpark that I'm at, so I'm very comfortable. Where did I come up with this idea? Well, I decided for this particular session that I was going to go shopping in the stocks that I don't normally shop in. So I looked for stocks with all of the characteristics that I normally want, except I looked for quality at 60 to 65. In other words, I looked just below the bottom of the excellent quality range just to see what might be there and what might be ready to pop up or might be very interesting. That's where I came up with the idea for Cash America. It's a small company, and again, caution. If the government gets involved in regulating this industry, you might want to run from this business model rather than just walk.
I have a feeling that bar chart that you showed, though, is probably a pretty good situation. We do have a question from Dolores. Ken, did you get deep enough into the study to know if the storefront operations are franchise or a branch of the parent company?
They're owned by the parent company. They don't deal with a whole lot of franchising, and they're moving into new models. They're actually doing things like car loans and longer term loans than just the typical 1 week or 30 days or something like that. So they are trying to diversify their business in these storefronts, and that seems to be the place where the growth potential will be for the next 5 to 10 years, especially in Mexico. Two of their most recent acquisitions are storefront acquisitions in Mexico.
Well, thanks, Ken. That's definitely a new one on the list for me. So why don't you go ahead and switch control back to me, and we'll press on. I do see that Mr. Lynch has joined us.
I have tried, so if you can hear me, I guess I had joined.
We can hear you just great, Si. Thanks for coming this evening.
Okay.
Thanks for having me.
Is my screen back into service here?
Yes, it is, Mark.
It looks.
Okay. All right, Si, I'm going to take a couple minutes and then turn it over to you for so you can bat cleanup here tonight.
All right.
All right. Well, my pick today is one that kind of surprised me. Coach, ticker symbol COH. I know that the vast majority of all of you are very familiar with the company, so I won't spend a lot of time. This did come to me as I was going through some of the screens we talked about a few minutes ago. In particular, this one is the ivory screen, where we're basically taking and looking for the companies in the top percentile with the notion of possibly shopping outside the portfolio. And you can see that I missed Coach as one of the blue ones are color-coded to show companies that could be considered that are outside the portfolio. Coach should also be blue. Coach is at the top of this list with a very attractive return characteristics, and we all know that it's recognized as one of the absolute industry leaders in the retail, special retail area that it competes in. So that's where I found the idea. Again, I thought it was already in the roundtable tracking portfolio, and my first question is, why haven't we added this yet? Here's a look at some of the track record for the company. Again, no stranger to any of us. What you're looking at here is a multi-year look at the business model, top line and bottom line, virtually up straight and parallel, with the exception of that period of renown known as the Great Recession back in 2008, 2009, known as the Great Recession, where many companies took hits to earnings and sales during the recession. And it'll happen again. When the next recession hits, companies like Coach and anybody else who's economically sensitive will get dented. It's just a matter of how badly dented do they get, and in the case of marginal companies, will they survive it? Coach is far from a marginal company. This is an established 60-year-plus enterprise, and again, we all know, although you've heard my confession, that I don't think I will ever understand the business completely. All the people standing in line to pay exorbitant prices for their products, but they do it, and they do it well. So I won't argue with that. You can see that according to Value Line, even the low total return forecast, which is again what we kind of zoom in as a solid second opinion or a checkpoint, the long-term 3 to 5 year forecast is for a 14% annualized return, so I don't feel that I'm being too greedy digging in a little bit deeper with Coach. So again, I look at this situation, I see a pretty consistent long-term trend, a little bit of a blip there during the recession. You can actually see that some of the forecasts you have to look really close, that sales number is actually dipped down a little bit below the trend line for 2014. As you dig in and read some of the stuff going on, you will read about competitive threats from places like Michael Kors. If you want to do a comparison stock study, the ticker symbol for Michael Kors is KORS. You might want to do a side-by-side, but again, that long-term picture makes a whole lot of sense to me in that 12 to 13% growth range as shown by the trend on the screen. Here's a look at those second two major milestones, the first being the profitability. Again, net margin, literally section 2 on your stock selection guides, 2A, only we take out the effect of taxes and take a look at net margin. And in this case, you see a fairly consistent company again, consistent results with the exception of pressures during the Great Recession. But again, a recovering situation, doing some great business in China and other places, and very easy to come to a conclusion that something in that 20, 21% or 22% net margin forecast seems to be something that makes a lot of sense and is probably defensible. On the long-term look at the PE ratio, you can see that, again, this is a premium company that has occupied the upper 20s for quite some time, but as we go left to right, during the Great Recession, even the PE took a hit, kind of dumped down into the low range, but it's been recovering. And again, this is the type of company where you can fairly easily make a case as you're studying the company of expecting for a projected average PE over the long term of something in the 18, 19, 20 PE range. You can see that Value Line for their 3 to 5 year forecast is assuming a PE ratio of 20. So again, if your numbers are greatly different from that, you might want to scratch your head a little bit, but for a company this good, that's a very normal PE. And this one kind of cinches it for me. This is our Chronicle. We're taking a look at a company. Let's look at a couple of the major points. Let's start with quality. The quality, again, we kind of think of this as the quality EKG for the company, and they don't get much better than this. That's virtually a straight line, and always excellent, and if anything, improving. What that means is either their growth rates or their profitability or their financial strength or whatever relative to their peer group or their competitors is actually been improving or getting a superior position over the last several months and quarters. So that's kind of an interesting position. Again, if Michael Kors actually does put a dent in them, and their growth rates or profitability is compromised, we would expect to see a deterioration in this over the long term. I personally don't expect to see that anytime soon. So quality is fine. Second of all, the price. You can see that the price, as many of us in the room have owned shares of this company, and the price has a very nice long-term trend as shown by the green bars. Those are split adjusted and dividend impacted, dividend influenced. So again, from left to right, what a really nice picture. The red line is the projected annual return. Again, no different than Section 5 of your stock studies. And we're basically taking a look at the return forecast over time. And that's what really kind of grabs me here. We had an awesome opportunity a few months ago. In fact, we featured that in our tin cup model portfolio back right at this peak. But what we basically see here is one of the best buying opportunities in this last 5 or 6 year time series, only exceeded by this time back here, again, in the depths of the Great Recession, when this stock actually got down into, I don't remember the exact dollar figure, but looking at it here, is somewhere in the teens. So back during the Great Recession, it was down in the teens. The fundamentals of this company have been strong for a long time, so this was the #1 buying opportunity within the last 6 or 7 years. This happens to be currently the second best buying opportunity within the last 4 to 5 years. And one of the other things we like to point out and help people understand is this notion of projected relative return. What we're doing there is we're taking the return forecast for the company and we're comparing it to the return forecast for the market. You hear us talk about sweet spots. If a company's in the sweet spot, its projected relative return is going to be between 5 to 10 percentage points better than the market. And that's what we're looking here. This would be the sweet spot on this graph. The other way to look at this and interpret it would be to simply say that anytime this pink or red shaded area is greater than 0, anytime it's above this 0 line, Anytime it's above the zero line, we're basically looking at a stock that is expected to outperform the market. Anytime it's down below, as we saw back here a couple times when the stock prices actually got a little bit toppy for a little while, we're looking at a stock based on our stock studies that is expected to underperform the market. So we want to avoid those. So what we're really looking for is times, like you see here, when the pink shaded area is in that 5 to 10% zone, literally in the sweet spot that we see right here. So this is what kind of clinches it for me. Coach, again, a formidable company that many of us know and love in our portfolios and has served us quite well. Now, Hugh's not able to join us tonight, but he did want to throw one more log on the fire when it comes to Staples. And again, this is kind of a special situation. Staples has been in the news here of late. Again, Hugh has a notoriously long-term perspective when it comes to this kind of stuff. He basically takes a look at a company that's got a decent financial strength, very competitive, probably, well, it is. It's the top company in that line of business. Longer term, not too sexy, not too exciting, but again, in mid-single digits for a fairly large company, dominating its industry to some extent. And now you can see that the stock price has actually plummeted as measured by these black bars. It's down here in basically 10-year lows. So has it gone sufficiently far that it is a deep value opportunity? Hugh thinks so. I mean, Value Line agrees. The long-term return forecast for Staples is 29%. I believe that this has now been selected 5 or 6 times for the portfolio. And again, with Hugh's notoriously long-term perspective, I'm sure he sees this as a turnaround opportunity that offers a great amount of potential. So that's for the audience's consideration also. And with that, we'll turn to Mr. Lynch, who wants to talk about delivering stuff. Cy, you still there?
All right. Yes, I had myself muted and was taking off the mute. But anyway, I am now unmuted and I am here. Tonight I'm bringing a new company to the portfolio, C.H. Robinson. It's a company that I think I had run into on some screens and perhaps heard some folks talking about and over the last several months. And then I believe either Ken or Mark mentioned it during the Let's Talk Stocks segment at Bink a couple of weeks ago. So I was doing a screen. You can see here that the lines are pretty nice up straight and parallel. Value Line has a decent 5-year low projected return of 12%, which is solid, but you'll see as I talk through where I came up with the company, I'm stressing even some safety aspects, even more so than just return. So let's go ahead and look at the next slide and see where it came from. Mark mentioned earlier the Ivory Soap rankings that he did. I went a little below Ivory Soap, maybe in the Dove bar or something, have a little bit of adulteration added in, perhaps, and went with a 95 manifest rank. And then I took those companies and sorted them by financial strength. I was deciding to be very conservative from a safety perspective this month, and at the time I was doing this, my par was below 8%. I think it was about 7.8, if I recall. So the market's telling us to watch our quality. So as you can see, I sorted the companies by financial strength, and the one that pops there to the top is C.H. Robinson, along with the second one at the top, Expeditors International, which is a competitor of C.H. Robinson. So that's where I started, and you see Emphasis, which is a member of the portfolio, also up there at number 4. And really any of those top 4 and fact, everything you see on the screen certainly would fit my qualifications for the strong, super strong financial strength. You see they're all excellent quality, and I particularly liked, again, the top two, and to include Google as well, though I really wasn't looking for a technology company this time around, being in the sweet spot. So all of those looked attractive, and I chose C.H. Robinson over Expeditors by doing a mini industry study, which is the next slide. And you can see here the air transport industry as Manifest puts it out. Interestingly, C.H. Robinson, depending on what source you look at, is everywhere from an industrial company in the shipping industry to a technology company. I believe Morningstar has it as a technology company, and as I talk a little bit about what the company does, I think you'll see why it overlaps. Circled the places where my eyes went. You also see highlighted in blue the return and, again, the financial strength. The top return companies in the sweet spot, excluding Echo, being a little out of the sweet spot, although certainly would be a company potentially to consider. But I picked C.H. Robinson over Echo based on the yield, and then the earnings stability gave it a little bit of a nod over Expeditors International. But really, those three are all certainly good, solid companies to take a look at. Let's talk a little bit about what C.H. Robinson does. The next, I think, 7 slides are from a company presentation you can listen to all of and see the slides on their website if you like. They're a company you'll see from the bottom of the screen that has been around since 1905 and has been publicly traded since 1997. Now, they've really been in the format that they are now, which is a logistics, what's called a third-party logistics company since about 1980. When we look at their business segments, I'll tell you what they started out as, and then we'll see what they are now. As you can see here, they are a transportation and logistics company, and they are a service company. What they accent and where they are unlike the competitors that you saw back on the Manifest screen, specifically UPS and FedEx, they are a non-asset transportation company. They do not own the trucks. They do not own the equipment that ships the things that they're shipping. Instead, they are more of a broker working between the people who desire to ship the goods and the people who own the assets. You can see that they're widely spread out geographically as well as customer-wise. They have 37,000 customers. They work with 53,000 transportation providers, and you'll see why they work with that many in a couple of slides, because it's actually a very highly fragmented industry. They have a wide global network of employees in 26 countries and 234 offices. Again, they accent trying to give local service. They say that many of the shippers like to work with companies that are local, that are in their area, and interestingly enough, they use their technology that they mention there. Sometimes, let's say the Atlanta office of C.H. Robinson has a customer that wants to ship tomatoes to Alabama, but the trucks that would best serve this customer are in North Carolina. The Atlanta office can go into the database of C.H. Robinson and then find the trucks that's perhaps serviced in a North Carolina office, but again, having that local contact with the customer here in Atlanta, and that's why they have so many offices spread throughout the country and the world. Next slide. They believe that they are one of the largest transportation providers, and in fact they do contend, I believe it's the next slide, that they are the largest third-party logistics provider. What the third-party logistics provider is someone who is neither the owner of the assets, the trucks, that being a FedEx or a UPS, or the shipper themselves, the person who wants to ship the goods. In other words, they are a third party, and it's a rapidly growing area of the market. And as you see, they have about a 30-year track record since they have gone into this line of the business of approximate 15% annual growth in revenues and earnings per share. Next slide. Here are their lines of business. I promise you I'd tell you what they started out as. They started out as a lettuce shipper. That's the sourcing market area that's now about 8% of their revenue. And up until 1980, that's what they did. They shipped lettuce for people. In an area around 1980, they said we can take some of the knowledge that we have and expand it into this area of helping bring the shippers and the trucks together, and that's of course what they primarily do now. You see 88% of their revenue is done by transportation, and it's primarily North American truckload and less than truckload shipments. They have some intermodal, which is the rail, ocean, or air mixed in with trucking, and they have some international, but they're primarily a domestic truckload and less than truckload over-the-road company. Next slide. Here's a look at their customers, the people who are shipping the goods. You see that the majority of their business comes from the manufacturing sector and the food and beverage sector, with some retail mixed in, and then about 14% spread over various other products. About 500 of their largest customers is about half of their revenue. The rest is spread over the rest of those tens of thousands that they mentioned, but their largest customer is less than 3% of total revenue, which differentiates them somewhat from even some of the asset providers. Next slide. This is why I deal with so many truckers. This is their truckload shipments in 2011, but in the next slide you'll see the industry as a whole roughly mirrors this. You'll see that only a little less than 10% of their business, 8% was for large carriers with 400 trucks or more. About 10% were 10 to 400. The vast majority were small carriers, less than 100 trucks. And one reason the third-party logistics industry is growing faster than the shipping market as a whole is that the shippers want to deal with relatively few carriers. They don't want to deal with a bunch of people, and if there's just a few carriers, a few carriers that have more than 20 trucks, which is actually what you'll see on the next slide. If you need, for your business, you're a large manufacturer and you need 50 to 100 trucks, you're potentially dealing with 10 to 20 or more carriers, and businesses just are not wanting to do that anymore, so they're going to third-party logistics people like C.H. Robinson, like Expeditors International, to bring their business to them. All right, next slide. And here again is their competitive landscape. As you see, the industry is very fragmented. There's 250 truckload carriers. All but 4%, that means 96% of them have less than or have 20 or fewer trucks. That's what I was mentioning on that previous slide. So C.H. Robinson is bringing those small carriers to the larger customers, and the customers don't want to deal with a lot of various carriers, so they just deal with C.H. Robinson. Again, they have about 2 to 3% of the market for truckload services, but they are among the largest of the third-party logistics providers. I believe the third-party logistics industry, it's not on these slides, but I saw elsewhere's growing in the range of 10 to 15% a year, which is about twice the total shipping market, and C.H. Robinson believes that they can, of course, continue to gain market share and therefore grow even faster than the 10 to 15% that the third-party logistics is growing. And their strategy is on the next slide.
Cy, we're getting a question from Nancy, and she wants to know, would C.H. Robinson work with companies as small as only needing a single truckload, or do they work with larger companies that need truckloads in excess of 20 truckloads?
They work with all size companies. They would work with one truckload companies, and they also do some less than truckload expediting as well, although primarily they do work with truckloads.
Thanks a lot, Cy.
And here's what they're seeking to do. You see their goal is long-term compounded annual growth of 15% of revenue, operating income, and earnings per share, which they have done over the last 30 years, you heard, as well as the last 10 years, actually exceeded that over the last 10, and they intend to increase their penetration of the market with new customers, as well as get more business from their existing customers. Again, the concept of third-party logistics providers are new to many companies. They have been doing their own internal shipping management, and so they may start out giving, say, 10% of their shipments to C.H. Robinson to see how it works out, and so their goal is to increase that to a larger percentage, of course, ultimately, hopefully 100% of that customer's business. They are also looking to add any services that are consistent with their business model and expand potentially globally. As I mentioned there, I believe, I didn't have a slide up there, but I believe it's about 78% domestic right now. So again, they are primarily a domestic company, but they do have a smattering of international as well. All right, so that tells you a little bit about who C.H. Robinson is. Here is the wrap-up on my judgments, our three key judgments that lead to our bottom line of projected annual return. I projected sales to grow at about 11%, which is roughly what Value Line and Morningstar are projecting, a little bit below the 10-year average, so it's closer to the last few years because they are impacted by the Great Recession, although you saw from that first chart they weren't horribly impacted. They are slowed, but you see that's well below the company's goal of 15%. So certainly we'll be pleased if they make their goals, but I'm going to project at the 11% range. Their net margins, the company basically does not provide margin guidance. They say they have little visibility on margins. Margins are just a function of a lot of factors they really can't anticipate. That means fuel, as well as the economy. You know, when they want to increase their volume in slower times, like we've been experiencing in the 2008 to 2010, 2011 timeframe, they had to cut their prices, which would narrow their margins. Of course, they're impacted now by higher fuel costs, which again impacts their margins. But then when the market turns, the margins expand. They basically say their experience has been that long-term their growth comes from volume growth by shipping more goods rather than margin. They, of course, try and manage margin, but you can see here historically how the margins have varied. Some are trending up, but they seem to be settling fairly well right there around that 4.3, 4.2%, which is what I'm projecting. PE of 24, which again, as you can see, is about where it seems to be trending from the chart there to the right, and all of that along with I believe about a 45% payout ratio, which gives you a pretty nice 1.9% dividend yield, leads to a 16.5% projected annual return. So C.H. Robinson is my choice of the month.
Good stuff. Thanks, Si. All right, we're running up against kind of our time limit. We usually try to do these in 75 minutes. So, Ken, I think we should probably go ahead and launch the poll. We'll give the opportunity to vote if you like any one of the four, or if you would prefer to vote for none of the above.
I protest that I don't get to vote.
I know it, isn't it awful? You hang out in this back room, and this is what we have to live with, Si. It's interesting. It'll be interesting to watch going forward how Echo, which I think sounds like an upstart direct competitor with C.H. Robinson, how the two do in the portfolio. I think there's room for both of them.
Sure, absolutely. I think they serve differently, and you could probably even argue that Expeditors potentially would fit, because Expeditors is a much more, I haven't studied it closely, but it's much more international than either Echo or C.H. Robinson.
I'm going to hold the poll open about another 30 seconds. We have 75% of you voting. All it takes is a click of your mouse on your choice or on none of the above. Oh, I've spelled none very nicely, haven't I? I have a J in the middle there.
Well, I figured that was some kind of Slovakian.
It's the Spanish spelling. It's the Spanish spelling.
Spanish?
The J is silent.
You're in the logistics mode. You're thinking international.
Yes, I am. Okay, I'm going to close the poll, and I'm going to share the results. I think you can all see what the results are. It looks like we're going to double down on Coach, on Mark's choice. That's always walking the tightrope when we're going to pick what Mark picks here, but but I think that it's a great choice this time, Coach. So let's see where it takes us the next few months. I'm going to hide the results, and Mark, you're back to your screen again now.
Okay, well, that wraps things up kind of for tonight. We're going to go ahead and I'll go back to the cover slide in case anybody wants to contact Ken about future sessions. But we can leave the floor open for a couple of questions here before we sign off tonight.
Okay. Mark, we're getting a comment from Marianne and Phil in Northeast Ohio that some companies, if you tell them, will send press releases directly to your email, and Coach is one of those companies. So if you're a Coach stock watcher and you'd like to have press releases from the company, go to their investor relations website and sign up to get them right into your email.
Yeah, excellent suggestion for stock watchers and shareholders, without question.
Don informed us that Staples is closing a number of stores, and in fact took quite a hit today in the market, and it's accelerating the closing of some of its stores. So it's trying to stay ahead of closing stores that are not making a decent profit. I think that the announcement was out there earlier, and the news actually is that Staples is accelerating the process.
Yeah, and that's something Hugh is definitely very much aware of. And again, he puts it in the category, again, being that notorious long-term thinker of they really are just doing some portfolio management of their assets.
And then Herb Lemkel, one of the Mid-Michigan directors, wants to get an opinion about how closely you think these logistics folks are tied to the growth of manufacturing in this country.
Well, that's a tough question. Si, you want to tackle that one?
Well, it would certainly, let's see, I'm just checking a slide that I have here. I'm just looking. Certainly, you would intuitively believe that they would be tied to manufacturing, and in 2011 C.H. Robinson, 41% of their revenues was from the manufacturing businesses. So certainly they are impacted by manufacturing growth or lack thereof. Fortunately, since the Great Recession, we've actually seen resurgence in American manufacturing, which I think certainly has helped companies like C.H. Robinson, although they are pretty well diversified in that, let's see, I'm doing my math real fast, 45% of their business is food, beverage, and retail. So they are what, about 50-50 between manufacturing and non-manufacturing retail type of business.
Well,
I can actually,
Mark. Yeah.
I can kind of jump on and pile on a little bit here. And we don't have time to go into this in any great detail, but if you really think about it from a macro standpoint, a macroeconomic standpoint, one of the greatest forces at work here is the price of fuel to move things from one place to another. Mm-hmm. If the price of fuel actually does go up on a global basis, on a global relative basis, that actually favors American manufacturing. And, and then it also doubles down in the effect of these logistics companies have to factor that in and do whatever brand of optimization that they can with that cost. So it's kind of it could actually be a positive force, although it'd be a challenge. It could actually end up being, from a macro standpoint, not such a bad deal. It'd be interesting to see how those logistics companies would answer that question. Maybe we can find a way to get that to them.
And Mark, to just jump on top of that point as well, I've actually seen trucks in the last 2 months advertising on their side walls that they're running on LNG, liquefied natural gas.
Absolutely.
And if that becomes some type of a prevalent source of fuel, with the amount of gas that we have in this country, that I mean gas in the ground, guys. Okay, that means that might be something that gives us a real competitive advantage going forward.
Absolutely. And right now, natural gas is dirt cheap, and currently liquefied natural gas is not easily transportable. That's something people are looking at trying to do. But again, it's something that would favor the domestic market and keeping the gas here.
I think
gentlemen, I've cleared the questions box.
I was going to actually, Ken, I was going to suggest that we kind of close down with a comment that I saw a few minutes ago, back several minutes ago. Nancy actually suggested for another screen demonstration the Nicholson triple play. And we don't have time to go into it, but one of the reasons it didn't come automatically to mind is that's something that we typically tend to think of during the other end of the stock market when it's kind of bearish and things have been kind of nasty for a while. The triple play will identify more candidates. We used it extensively back in 2007, 2008. But I will add a Nicholson screen to that set of screens on the Manifest Forum. And again, we're basically looking for companies that have depressed stock prices and opportunities for margin enhancement and PE multiple enhancement also. So we'll dig into that subject a little bit more, but I thought that was a nice comment to kind of close things up.
That actually came from our friend in Western Michigan, Barb Fritz, Mark.
Oh, excellent, excellent.
Okay.
All right, Ken, you want to sign us off?
Bob and Arlene Medlin are telling me that the Stocks Club bought C.H. Robinson this evening, so you had one supporter there for C.H. Robinson. And all Julie wants to know, Mark, why Cy's picture doesn't have a Braves hat on.
He has a Braves tie on.
Okay, great. my martini
right,
arrived about... Oh, go ahead, Cy.
I was just going to say, the Braves clinched a playoff spot last night, probably against Mark's team, St. Louis, although St. Louis isn't quite there yet. But.
Well, we can only hope.
Well, I'm going to focus on the martini that was delivered about 10 minutes ago here, guys. So we're way over time. Thank you all for coming. We hope you enjoy what we do. And let me announce right now that the next roundtable is scheduled for Tuesday, October 30th. And you will be receiving a reminder from my lovely wife, as always, Thank you all for attending. We did pass the 100 attendee mark again tonight. That marks 9 months in a row now. We're very happy about that. Let's start aiming for 200 now, folks. Thanks a lot and goodbye.
Good night.
Thank
Thanks,
you, gentlemen,
everybody.
so
Good
much.
night.